You're watching a Carolina Business Review special presentation in partnership with the Charlotte Chamber of Commerce. Major support for this program provided by Babson Capital Management, a leading global asset manager with over $200 billion in assets under management. Learn more at babsoncapital.com.
This room can be seen as a metaphor for the economy from 2008 to current day. Wide open, not much going on, not much excitement, no buzz. And in just a moment, we'll be filled with dialogue, with networking, with excitement, with optimism. I'm Chris William, and welcome to this very special Carolina Business Review in conjunction with the Charlotte Chamber of Commerce. We will be speaking with the Carolinas' leading executives about not just what's going on in the Carolinas, but what's going on in the nation. What are the pitfalls? What are the challenges? What should we be excited about? And what is of most concern? We will start our dialogue in just a moment. Please stay with us.
This is the 2015 Economic Outlook Conference, featuring David Carroll, Senior Executive Vice President, Wells Fargo, Susan DeVore, President and CEO, Premier, Lynn Good, President and CEO, Duke Energy, Jeffrey Lacker, President, Federal Reserve Bank of Richmond, and Brian Moynihan, Chairman and CEO, Bank of America. And now, from the NASCAR Hall of Fame in Charlotte, your moderator, Chris William.
Welcome. Welcome, Happy New Year, Happy Holidays, and welcome to our broadcast, and welcome to our guests and panelists. And I might say esteemed. Thank you for your time, and thanks for taking time to do this. Dr. Lacker, I'm going to start with you because you seem to be the one that, everybody talks about what the Fed's going to do, what the Fed didn't do last year, what the Fed may do in 2015. And I'd like you all to answer this question. How, just give us a sense, maybe non-clinical, non-scientific, how you feeling about the economy in 2015?
I'm feeling reasonably positive about the economy in 2015. The broad context to keep in mind is that we've had growth at a just modest pace since the recession. Averaged about 2.25%. I think we're going to get a figure like that for 2014. Over that period, we've had little surges in growth, but they've petered out. They haven't been sustained. I think this time seems a bit different. I'd point to consumer attitudes about their future job prospects driven by changes in the labor market that I think are very helpful. There's an increased dynamism, an increased fluidity in the labor market that we've picked up over the last 6 to 12 months, and I think that augurs well. In addition, I'd point to business investment demand, particularly in equipment, that's aiding the manufacturing sector, and some strong innovations that are coming along the pike there that I think are going to help.
Susan, I want to come to you. How do you not let the challenges in healthcare and the continued rollout of ACA? Two questions. How do you not let that kind of factor in what an accurate, broad view of the economy, and what is your broad view of the economy?
It's a complicated question for healthcare because on the one hand, healthcare is likely over the next 10 years to create the most new jobs. On the other hand, it's a huge economic challenge for the country. And in 2013, the level of healthcare spending was at its lowest level since 1960 at 3.6%. 2014, it's 5.6%. And growth rate, and that's due to the expansion, the Affordable Care Act. So the societal issue is around how do we cover an aging population with 10,000 people entering Medicare every year for the next 19 years, and at the same time, make it affordable, make it safer, make it more high quality and better outcomes. So the economy recovering has allowed probably more people to access health care in addition to the Affordable Care Act, but it continues to drive a cost equation that is challenging for the country and for employers.
Brian, what are your customers saying to you about the economy?
Well, if you sort the institutional customers and then the consumer customers, the consumers continue to spend. If you look at November, the holiday season, you look at it so far in December, they're up anywhere from 2 to 4%, depending on how you sort of look at it, of spending this year versus last year. The gas price reduction created a negative 1.5% in spending, and it's been covered up by re-spending that money out in the economy. So consumers are spending, and as Jeff said, basically the attitude that you've seen the consumer confidence numbers continue to rise. and you've seen the attitude about future work prospects continue to rise. You still have, from a Fed perspective, the wage growth question, and is there kind of inflationary pressure on wages that will then lead them to speed up the pace of rate movement. And then on the institutional side, the companies are making good money. They are very efficient. They continue to apply technology in ways that they never thought. Their awareness about the Affordable Care Act, the awareness around the Affordable Care Act raised CEOs' awareness of how much they were spending on healthcare spending, and they've figured out creative ways to drive it down. And so they're making good money. They have plenty of borrowing capacity, and it's really the final demand pickup that's still left. So we're getting a modest pickup in that, and I think people feel good about it.
Lynn, what do you think? What's your view?
Similar comments for our industry. We have seen some optimism around job growth in our areas. We cover about 20% of the population in the U.S., and we're finding about 20% of the jobs created in the U.S. are in our service territory, so keeping pace with that. We've seen good industrial growth. We've seen housing come back, so we're adding customers at a much more rapid pace, particularly here in the Southeast than we did several years ago. But the one point of caution that I would indicate for our industry is that our industrial sales are still not at the level that they were in 2007. And you can see indications of that here in the Carolinas when you look at the fact that our job creation in the Carolinas has been primarily in urban areas, not in the rural areas. 60% of the jobs in the Carolinas have been created in the urban areas. So I still feel like there's some opportunity for improvement that we'd like to see as this rebound continues to expand and broaden.
You know, David, last and certainly not least, at least in this opening part, but David, you have an interesting job. So you're a banker and a capital markets guy. You heard Brian's comments about some of what they're seeing. Do you see something different?
No, I don't. I would agree with everyone on the panel here. If you think about the distractions that our economy could have been preoccupied with this year, we've had very polarized electorate. We had the distractions of the elections themselves, the emergence of ISIS, Ebola, wars all over the place. Market volatility has made a reoccurrence. And yet, the most recent economic activity is unambiguously very positive. Strong retail sales, good manufacturing growth. On the employment front, we've averaged 280,000 jobs a month for the last 3 months. That's ahead of 194,000 a month a year ago. So there's gradual but persistent positive movement. And we see it in our business. Our loan business is very good. Underwriting criterion, the Fed, I think, released a report on this a week ago, has become very aggressive, circa 2006 maybe, some places. But nonetheless, demand has been good. Deposit growth has been good. And in our business in particular, this recent spate of market volatility when we had the drop in October and then in the past week, for the first time since the financial crisis, investors didn't rush to the sidelines. They've hung in there, used it as a buying opportunity. So all that taken, I'm actually more optimistic today than I was last year at this time.
You know, Brian, you said something, and Dr. Lacker, I want to ask you about this. Brian made mention about, almost in passing, about cost of oil, cost of fuel. Is this what we've seen so far in the drop of oil, is this a seminal change in this economy? Does this change all the calculus now for business?
I don't think so. I mean, it is an important change, but take the consumer side first. It's like a tax cut, and it's going to add to spendable income for people, and we're going to see a boost to consumer spending. But gasoline prices can't go down forever, so we can't get a repeat of it forever. And so it's going to be a one-time level shift in consumer spending, and then you look at how consumer spending is going to track forward for there. So it's not going to have a sustained increase on the rate of growth in consumer spending, maybe just a sustained increase in the level. On the industrial side, it's a fairly major change in cost and relative prices, and there'll be some pullback in investment spending related to oil and gas exploration. And you'd expect to see some sort of manufacturing investments predicated on those prices shift somewhat over time. And those will play out the way they usually do. We've been through this before. I think markets will wait and see how permanent it is. I mean, this could be a transitory dip. We could be headed back to 100 in a couple of years, or we could stay here. The futures curve suggests we're more likely to stay in the 50 to 80 range over the next couple of years.
Yeah, Brian, you made the comment. Do you think there's something different about this time on oil?
So if you think about it from the U.S. economy, you've seen spending among more affluent customers growing much faster than general populace. What gas price reductions do is give the general populace more money to spend. So in the broader lower income categories, it's middle of income down, and that means it's real money to real people. But I think that the tension against that is it was an industry which had the growth in it. So in the places that were engaging in production of oil, the question is what's the impact there relative to the impact and the overall benefit for their whole country as a whole. But I think in some ways, the more interesting question for the economies around the world is this impact of this change on the global scene and how that plays out and what it's done. And what you've seen is the market shake on a global basis because of this, whether it's the stories today about the Petrobras capability to produce at these prices or the situation in Russia and all the different places. This is a global phenomenon. So the U.S. is the biggest consumer, nip and tuck with China. But the reality is where the production comes from, this changes politics pretty quickly. And that's the question is still not answered, is what the impact that will have.
Yeah, David wanted to say something, and then...
Yeah, just to pick up on Brian's point about this being a global phenomenon, if you look at a chart of global oil consumption since 2000, it's flat to down for 14 years. Developed countries are consuming about 8% less in petroleum today than they were in 2000, and the developing world's up about 20%. But the net is, for 14 years, actual gross oil consumption is down while production is surging. In 2009, the U.S. was producing 5 million barrels of oil a day. It's 9 million today, and we're not the only ones contributing to supply. So there's I don't know how transitory it is, but for 14 years, gross consumption has trended down, and we've got more supply on the way. So I think it has huge implications for our economy and for the developing economies as well. If their consumption tails off a little bit, we could be in this low energy cost environment for a long time.
Yeah, Jeff?
Yeah, the thing to remember about the global impact of oil is that the fall in the price represents a transfer from oil producing net export countries to countries that are net oil importers. Now, from that point of view, you might expect it as sort of a first approximation that it's a wash, but the conventional wisdom, and I think this is right, is that the net oil importing countries are going to spend more of it than the reduction in spending of the net oil exporters, who tend to save a lot of it.
Yeah, Susan, you're nodding your head like you either agree or, yeah, kind of, sort of.
Well, not as a healthcare person, but I was just sitting here thinking that what it tells me is that when we put our mind to something as a country to change the global economic environment in an industry, we're able to do it. And we have been able to do it a lot faster than all the predictions would have indicated at the time that we were politically debating whether to do this or not. So that's actually what I was sitting here thinking.
So, Lynn, I'm looking at you being in the energy business, and I think you've got to have an opinion. Has it changed that quickly? And again, not to put this word in your mouth, but is this a secular change in oil?
I would echo the comments that Brian and Jeff made, but the one thing that goes through my mind is someone who uses all different fuel types to produce electricity. This is a reminder to us that commodities are volatile. We think we know what they're going to look like in the future. We never know what they're going to look like in the future. And so to have some resiliency to address commodity changes is something that we need to be able to respond to. And in my business in particular, to not have a mix of commodities that we're dependent upon is a long-term vulnerability. And we're blessed in this country to still have a mix of natural gas and nuclear and coal and renewables and other things for that important infrastructure of energy.
Brian, you made this comment, you're talking about a nip and tuck with China. Does oil change, again, the dynamic geopolitically, certainly, but how does it change? How does it change kind of the policy, not just of the U.S., but how does it kind of shake up policy in general?
Well, I think Jeff pointed out, you have countries that have been producing oil, selling it, and creating vast stores of wealth. You've had countries who have built their economic fiscal budgets around oil at certain prices that have a dislocation. And you have other countries which it's a part of the economy and they import some and make some and it has an impact, but there's a lot of other stuff going on. And so I think you really have to go country by country in terms of what was the oil used for. to create future generation wealth, well, they could take a price cut and hang on because they create a little less wealth and recovers. If it's current budget spending, that country is in economic stress. If it's a big employer, it creates a different issue, and you can go around. Or if you don't have it, I was just in India a couple weeks ago and with the Prime Minister and the Finance Minister. This is a big deal to India because this kind of drop in prices is a big deal for Japan and India and places that all came in. So it changes the order of where the money is spent, what the issues are, and it makes allies of people because they need the supply of energy. And it's not good for the United States to look at the world through our energy lens, because at the end of the day, we're developed past the point. So in these developing countries, they got to have power, they got to have energy for all. We've got to help them develop multiple ways to do it. But it changes their calculus because whatever they were going to spend becomes cheaper.
So, Jeffrey, last question, and we'll move on to something else, specifically to oil. Is there any downside, no pun intended, but is there any downside for a decreasing oil cost in the United States?
Well, as I said, I mean, the exploration, a lot of the exploration we did, some measure of it was predicated on fairly high prices.
But I'm sorry to interrupt you, but isn't that a short-term disruption? Not that that's not important, but is there really any downside long-term?
Long-term, it's a good thing.
Yeah, okay.
Give an economist long-term, everything adjusts back.
Right. In the long term, it's all a good thing.
It's all going to come back. So.
Susan, you made, in your opening comment, you said something about the cost of health care and how it's slowed down. Is the rate of increase, is the rate of inflation in the cost of health care, again, is this a change that's here to stay? Are we going to see a dropping acceleration in the cost of health care?
I've been very pleased with the proactive efforts of providers to change the way care is delivered. And Brian spoke about employers getting engaged and how do we keep people healthy longer and reduce the overall cost. I think it's going to continue to be 1% to 2% higher than the growth in the GDP. It's just the numbers of people on the rolls, the changing mix of the population, these high-tech drugs, the number of chronic conditions. I mean, the reality is it's slowed from 2% above GDP growth to 1%. I think the activities will continue, and so the hope would be that we could contain it at that 1% level above GDP growth.
Okay, so Lynn, David, the further deployment of ACA in 2015, how do you model out, David, in the operating committee at Wells Fargo, how do you model out what this is going to look like the next 5 years from a cost standpoint? And can you?
I had hoped to be able to answer that question for you, Chris, but seriously, I'm not an expert on that, but we've taken a lot of steps, as I know all these companies have, to bend the cost curve, to focus on wellness. Yeah. And to have the plan participants take more ownership in their own health outcomes. And I think you'll see big businesses continue to do that. We've got, it's not means testing in the current vernacular, but our higher income people pay more as a percent of their income than the lower paid. And I think those kinds of things will continue. But in terms of 5 years out, I have no idea how to model that.
Lynn, do you have an answer?
You know, we look at it as many years, and we always model several years, but I think the uncertainty around it makes it a little bit difficult. You know, we're looking at the excise tax that could be an issue 2018 or so that's within 5 years. We are focusing on controlling costs, which I think a number of people have talked about, very aggressively working with employees on wellness programs, and that has been a win at Duke. We've had a lot of adoption of the concept of participating in the wellness programs. And I do think the visibility and the focus on this has been a net benefit for both employees and retirees. We continue to have retirees that are very important to Duke Energy. And I just see it as such an ongoing, significant part of the cost structure of doing business with a large workforce that it requires attention to all of the regulations that are developing so that we can make the right decisions. But it's complicated.
Yeah, Sue, go ahead.
I do think this asymmetrical expansion of Medicaid has significant implications for employers in states that have not expanded Medicaid, because essentially that lack of coverage for that patient population, and the cost of that is in some ways shifted to employers. Mm-hmm. And in other ways, the taxpayers are basically funding we in the states that didn't expand are funding the expansion in the other 28 states.
In North Carolina, Governor McCrory has sounded more friendly toward putting his arms around an expansion of Medicaid within the state boundaries of general operating money. Do you expect that the states like North and South Carolina that have not accepted this will have to relent or will relent sooner rather than later?
It's an interesting question. It's a political question. I think from a logic perspective, covering those populations in as efficient a way as possible is good for the state and good for the population. I think politically, I actually think the change in Congress and the seats gained in the Senate and the seats gained in the House create an opportunity for a conversation. I think that politically speaking, it will have to be reframed to be a Republican idea with maybe a new name and a new description and a waiver. But I hope it's possible. I don't know. The political lines of the hard line, right and left, sometimes make that difficult.
Yeah, Brian, please.
I'm going to move from the political more to the practical. As in a business-oriented organization like the Chamber, it's the one thing I'd say to our business colleagues is this stuff works. And so for the first time in many, many years, and Andrea Smith, who is one of the executives of the Chamber here, runs our HR team, and we were able to not pass through any cost increase this year to all the employees for the first time in forever. No deductible increase, no anything. So everything went through by the types of things David and was talking about in terms of wellness, Susan and Lynn. If you think about that, that's a phenomenal thing. We insure 1 million people. We have 225,000, 230,000 employees, but it's 1 million people run through our plans on a given day. And the ability to say there's no cost increase to them, go back to the question of the impact to their spending is terrific. And it was done by 80,000 people measuring their steps, getting measured and screened for the biometric screening, identifying early conditions, counseling, and over the course of just 2 years, we've been able to stop having people pay more. And that's pretty phenomenal. So if people are thinking whether this works, it works. And if we can get that through, then the questions of what the political cost is. And you're seeing the public side unions start to think about these programs. You're thinking governors and mayors when I go around the country and talk to them. So I think if you can get that through the system, we can not only bend the cost curve, because it may keep going up, you can bend it, but what you can actually do is bend it for the benefit of the broader population of employees and families, and they can spend the money.
So can you change it? Can you hold back that force for 1 year, Brian, or do you think that this might be a longer term trend?
We'll have to see, but in 1 year we went from high risk factors went down by 4% in the population, and low risk factors went up by 4%. And as you start to project that out, those factors, if they hold, are not going to wouldn't have become an issue if they're negative or positive for years, because the population age is 40 years old. So you're betting many years down the road. So I don't know if we'll be able to hold on to it forever, but effectively for over half our population, we dropped our cost by half over the last couple of years, and we'll continue to drive that down.
Yeah, Susan,
Well, and we're seeing a lot of large employers and even medium-sized employers start to go direct to their provider delivery systems to say, you know what, I've got my wellness programs. If you can help me manage the care of the population of my employees over time for the long haul, and you're invested in the community as a community provider, especially if you have a national network, we think there will be increasing employer and provider direct relationships.
Jeff, I know this is not really in the wheelhouse of the Fed, but what would you say, knowing what you know about how the economy works, about monetary policy, not to have you wade into fiscal policy, but what would you say to businesses about ACA now in year 2 of this deployment?
I'm certainly not an expert and wouldn't be able to advise them on how to navigate the choices they have, particularly in the small business space. This is something, though, we've been hearing about for a couple of years. In the run-up to implementing ACA, our business contacts were telling us they were perplexed. They were devoting a lot of management bandwidth to this, to figuring out their approach to the initial launch, what they were going to do with their employee population. Should they change the terms of the plans they offer? Should they send them all to the exchange? Should they constrain employment to avoid going over 50 or going over 30 hours? So it's been just the change in the configuration of the laws and regulations around healthcare provision by small businesses has been, I think it's been a drag on growth. Maybe not a large one, but it has been something that's occupied the time of a lot of small businesses in our country. And I think sooner we get through that, the sooner we get to a stable configuration that people can make sense of, and the rates kind of settle down to where they're going to be, a kind of a configuration that they're going to show in equilibrium, the better and the easier life will be for the people who are really driving job growth in our country.
David, you?
Yeah, just picking up on that, and you certainly can't lay all this at the feet of the Affordable Care Act, but with respect to small business and some of the improvement in employment lately, we have a big small business practice. We're the largest small business lender in the country. And while we've had a surge in job creation this year, and particularly in the last quarter, and unemployment has come down, we are still over 2 million jobs, full-time jobs, shy of the pre-crisis peak. And we hear frequently from our small business customers a lot of angst and indecision around the impact of ACA, and I think it on the margin has impacted the composition of employment gains that we've had here. It's one factor, but I think it's an important one.
Yeah. You've been watching part one of the Carolina Business Review Charlotte Chamber Economic Outlook. Please join us next week for part two.
You've been watching the 2015 Economic Outlook Conference, a Carolina Business Review special presentation. For more information, visit carolinabusinessreview.org.